The biggest question on every investor's mind right now: will the Fed taper their balance sheet? Will they actually raise rates? And if so, how much? Because they've already begun tapering their asset purchases. They've been reducing the pace at which they are buying assets to the point where in March, they will no longer be adding anything to their balance sheet. How soon after that will they start selling assets? How soon after that will they start raising rates? And if they do start selling assets, number one, how will they actually do it? And what impact would that have on the markets? Ready? Let's dive in. Today's sponsor is Element Nutritional Sciences, but more on that later. Take a look at this chart. This is from the Federal Reserve. This is an update from Friday that shows the Wednesday's closing balance of the Federal Reserve's balance sheet. And you can see, though it is still moving up and down from week to week, you can see clearly now it has started to move more sideways than it was before. And within just a few weeks, this will no longer be moving up or down in general. Obviously, it'll still fluctuate, but for the most part, it'll be moving sideways. The Federal Reserve is committed to raising rates shortly after this purchasing is done. Again, this is just a few weeks away in March. But the interesting part to me for this discussion is what they do when they want their balance sheet to start to decline, because they've said that after they begin raising interest rates, then they're going to start talking about reducing the size of their balance sheet. And this brings up some pretty significant questions about how they can actually go about doing that. Number one, they have $2.7 trillion worth of mortgage-backed securities on their balance sheet. That is one of only two things they are legally allowed to own on their balance sheet. The other one is government debt, treasuries. And the fact is, these mature at a far slower pace than government treasuries do. Now, speaking of government treasuries, the Federal Reserve has approximately $2.5 trillion worth of treasuries that are maturing just within the next 3 months. Nope, that's wrong. 3 years. $2.5 trillion of government treasuries maturing just in the next 3 years. Now, if the Federal Reserve decides to take a completely passive approach, what would end up happening to the balance sheet is every time some of this debt matures, their balance sheet declines by that exact amount, because essentially what a maturing bond is just the government paying them back for it. The government owes dollars to the Federal Reserve like they owe dollars to anybody who owns a treasury. So the government would pay that back, the bond would evaporate, and the Federal Reserve is the one that creates dollars. And so those dollars don't just sit on their balance sheet, those dollars just evaporate, they disappear, they go away, and so the balance sheet declines. But it wouldn't decline at a steady pace. It would be extremely erratic, and it would drop by the amount that matures during that given time frame. So there might be some weeks, some months where it drops by a lot. And then the federal government, when those bonds mature, they then have to go out to the open market and do a huge auction to go get a new debt to pay off that old debt to the Federal Reserve. And so it could result in some pretty erratic behavior in the bond markets. So they most likely won't want to just have a completely passive approach, and they'll want to buy some of it back, some debt from the open market, in order to have a very smooth runoff of the balance sheet. Otherwise, barring any cataclysmic event in the financial markets within 3 years, just the treasuries alone, you would see the Federal Reserve's balance sheet decline by about $2.5 trillion. And I don't think the bond market could support that. They also have the opportunity here to perform somewhat of an operation twist for some soft yield curve control, even as they're selling assets into the open market. And not to peg rates lower across the curve, but just to make sure anything unexpected doesn't happen in the bond markets, no yield curve inversion happens, and if one end of the yield curve is getting too steep or too flat, they could sell or buy just enough so that their balance sheet is still running off, but in a way that doesn't cause any unexpected things to happen in the bond market. Now, the other thing that they might be looking at here, which they've actually mentioned before, is that they may want to just keep all the treasuries, renew them all. Every time one matures, they'll go and replace it by buying up that same amount of debt off the open market, and instead just sell mortgage-backed securities. This would have the added benefit of not putting any undue pressure on the federal government in terms of its expenses on debt, because really any debt that the Federal Reserve Reserve owns is interest-free for the federal government because after its expenses, the Fed sweeps all profits back to the Treasury. So any debt that the Federal Reserve owns is interest-free for the government. If the Federal Reserve does not go out and replace all those treasuries, then the debt service cost for the federal government becomes more and more expensive as they actually have to start paying that interest back to somebody. So instead, the Federal Reserve might decide to just start selling their mortgage-backed securities. Now, another reason they might do this is because mortgage-backed securities are probably not very quickly going to just passively run off their balance sheet. This is because these mortgage-backed securities aren't going to mature within the next 3 years like their treasuries are. Instead, mortgage-backed securities mature when mortgages are paid off. Now, that either happens 30 years down the road from when the mortgage is created, or that happens when the mortgage is paid off through the customer sells their house, buys a new one, pays off the old mortgage because they get a new mortgage, or they refinance. And clearly, nobody's refinancing right now. When mortgage rates are rising, nobody's going out there and saying, hey, I want to pay more for my house, so I'm going to go get rid of my old mortgage that has a lower interest rate and get a new one that has a higher interest rate. Nobody's doing that. And also, as mortgage rates rise and housing costs become more and more expensive, fewer and fewer people are moving and replacing their old mortgages. And so that's going to have downward pressure as well on the rate that these mortgage-backed securities mature for the Federal Reserve. So the Fed may choose to just start selling these so that they don't have any impact on the treasury markets, the bond markets, and then they can start dumping things off of their balance sheet like mortgage-backed securities, since those ones aren't going to run off naturally. While this would have upward pressure on mortgage interest rates and subsequently downward pressure on housing prices, you know my opinion if you've seen any of my real estate videos. I still do not think this presents enough of a risk, enough pressure to combat the supply and demand dynamics at work right now. And I still do not see any reason to fear investing in real estate at this point. Of course, I will let you know if anything comes up that makes me change my mind. By the time we were to experience a major crash in real estate as a result of anything like this, it's far more likely that the Federal Reserve will have already reversed course, already started lowering interest rates again, already started buying assets onto its balance sheet again, because it's going to cause problems, what they're doing right now, and it's only a matter of time before they have to change their course. And at that point, when they do that, instead of selling assets, they're going to start buying them again to the point where they probably won't be targeting a specific number of assets that they're purchasing. Instead, they'll be targeting a specific interest rate for the things that they're purchasing. So instead of saying, hey, we're going to buy $100 billion worth of treasuries, they're going to say, we're going to buy enough treasuries to make sure that interest rates across the curve are not over 1%. Instead of buying a specific number of mortgage-backed securities like 40 billion, they're going to say, we're going to buy enough mortgage-backed securities to make sure that mortgage rates don't go above 2%. And can you imagine the stimulus effect short-term on the country? Mortgage rates go to 2%. Everybody doing a cash-out refinance, getting a big lump sum payment. Everybody doing a regular refinance to lower their monthly payments and get some extra cash flow to be able to spend. Can you imagine the short-term impact that that will have as far as a wealth effect goes? It would be absolutely enormous. It's the last card that the Fed has to play. Yield curve control, pegging rates all the way to zero across the curve or close to it. And at that point, that's when we have to start fearing hyperinflation, because we've seen the inflation we got as a result of the last time they did a major stimulus package, major economic bailout. Can you imagine the inflation we'll see when they have to up the ante and increase that intervention and increase that stimulus? And now for a word from our sponsor today, ELMT Nutritional Sciences. If you've been around the channel for any length of time, you know that I am very interested in health and wellness and fitness. Early last year, I decided to get my health under control because I had lost control of it. And over the last year or so, I've lost just about 60 pounds. And the key during that time was also a buildup of muscle mass. It is well documented how much muscle mass contributes to overall health and longevity, which is why it's so important to maintain muscle. The problem is this becomes harder and harder as people age. Many people actually end up developing something called sarcopenia, which is an age-related muscle loss disorder. Now, one reason for the development of this is simply an inadequate intake of protein, especially as you age. But there's another problem, because not all protein is created equal. So you probably are aware of this, but protein is made up of individual building blocks that are called amino acids. For your body to be able to use a protein in building a muscle, it has to have all of the essential amino acids in that profile. And so if you look on your food label, it might say that you're consuming 30 grams of protein. But if it only has half of the essential amino acids, you're not going to be able to use any of them to build muscle. You have to have all the amino acids in it. And if one of the amino acids is limited, then you're limited to the upper limit of that smallest amino acid. So if you have 10 of this one and 1 of this one, it doesn't matter that you have 10 of one of them, you're only going to be able to use 1 of all of them because amino acids work together for your body to build muscle. Now, you know me. I'm a carnivore. Meat and eggs are a very complete source of protein. They've got the entire essential amino acid package all in one, very bioavailable protein. But there's a problem with people who have plant-based diets. Most plants only have a few of the amino acids. This makes it difficult if you're on a plant-based diet to get adequate protein intake because again, even if the label says 30 grams of protein, if it doesn't have all of the amino acids in it, you can't absorb or use all of that protein. So if you want to make sure that you're getting all of the adequate protein that you need to be very careful about the specific types of plant-based foods that you're combining to make sure they have complementary amino acid profiles so that you can actually build muscle and use the protein in the food. Now, unfortunately, as you might imagine, this can become very difficult and time-consuming even if you know about it. And because of that, most people just don't pay attention to it, which leads many to not be able to get an adequate amount of protein in their diet, especially if you're on a plant-based diet. This is where Element Nutritional Sciences comes in. Element has spent the last 20 years almost developing a patent-protected formula with the University of Arkansas. Not only does it contain the precise blend of amino acids that is necessary for somebody to maintain and build muscle, but it's also 100% plant-based, making it perfect for those who want an easy solution to get the adequate protein intake and not have to resort to animal products if that's not your thing. Now, obviously, developing something like this wasn't cheap. It has cost almost $20 million over the last 18 years to develop this formula, a formula that has been proven to help with muscle retention and growth. But as you might expect, this is not a health opportunity I'm telling you about. This is an investment opportunity because you know that these days with stock market valuations up in the stratosphere and everything trading at crazy multiples, it is very difficult, to say the least, to find value. Warren Buffett's mentor, Benjamin Graham, always advocated to try and find companies to invest in that were trading below book value, which meant that if the company goes bankrupt and they have to sell everything and distribute the funds after selling everything, that the investors will be compensated for the amount that they invested, which means the company would have basically no downside and potentially unlimited upside. Well, obviously, those companies are extremely hard to come by, and Element Nutritional Sciences is not there, but it's close. Now, I'm not a shareholder and I do not own any Element myself, but this could be a huge value play here, especially considering the market cap. The market cap of this company is just under $30 million. Basically, it's priced at what it costs to produce their product plus a little bit more. The best part is, though, it's not an unproven product. It works, and it's not like there's no buyers. They are connected with major distributors. They already have their product in CVS, in Walgreens, in Sam's Club, plus a few other smaller retailers. Now, if you don't have any of these stores in your area, they are large national chains. And on top of all that, Element just got their largest purchase order ever, and it does not look like any of this is being factored in to the price of Element Nutritional Sciences. As if that wasn't enough, there is skin in the game with the insiders as well. The founder of Element Nutritional Sciences has poured millions of his own dollars into the company and owns 20% of the shares just himself, which means that this could be an opportunity to buy a company at a steep discount to what the market may value it at in the future, given the fact that they've already created a real product that solves a real world problem. Muscle loss, especially as you age, targeted at a growing demographic that quite honestly needs this product because it's very difficult to find adequate protein intake on a plant-based diet. And they already have buyers, they are already selling their product in stores and it's on store shelves. Just like I always say, this is not financial advice, this is not an investment recommendation. I don't own the company myself, and do your own research. As always, really appreciate you guys. Thanks so much for watching. Have a great day.